Welcome, everyone. I am Carrie Wall, RSI's Senior Director of Regulatory and Industry Affairs, and I work with the ARCI, QAC, and ELC volunteer member groups. So leading today's webinar are Eric Starks and Joseph Towers. Eric is the chairman of the board for FTR. He spent his entire career in the freight transportation sector, and he's a leading researcher in freight modal share analysis and forecasting. Joseph is senior analyst for rail at FTR, and his expertise lies in market analysis, data science, and economics forecasting. So thank you again for joining us. Thank you to Eric and Joseph for being here, and I will hand it off to Joseph to get us started.
Thank you, Carrie. Thank you, Haley. Thank you to all RSI. It's always a pleasure to be able to come on here and just break off, talk through what's going on in the latest, what's going on in the railcar equipment space. It's something that Eric and I get a lot of fun out of doing, so very thankful to be here. I'll go ahead and share my screen, and we will just hop right into the current freight environment before hopping into what's going on in equipment. So. Through our agenda for the day, we are going to start things off by looking at overall economic conditions. Eric's going to be the first one to kind of break down what's going on. So we'll start off with economic conditions. Eric's then going to talk through what's going on in truck specifically, just so we have an idea of what's going on, not only in rail freight, but in freight more generally. And then after that, I'll take over, talk through intermodal and carload, and then we'll talk through what's going on in current equipment markets. And with that, Eric, I will go ahead and turn things over to you.
Oh, Joseph, thank you, and thank you to the RSI folks. It's always a delight to hang out with all of you and to be invited back. So, man, there is so much going on. We're gonna hit the economics, and we're just gonna take off right away. So let's start with tariffs. Well, I know all of you very much enjoy having a nice deep discussion of tariffs, no, not really, but there's a lot of uncertainty around this particular market, and then how it bleeds into the freight market. So, a couple things. Let's level set. What have we kind of gone through over the last several quarters? Well, since the administration got started, basically we were sitting at an effective tariff rate of about 2.3%. And then, so what Joseph did and helped us do, he did a wonderful job of this, is every time the president would say something else, we would go in, we would update, and we would say, okay, what is the effective tariff rate based upon what they have announced? And so each time we would do that, we would come up with a new number. It wasn't saying that this is exactly what it was at that point in time, but it was based upon what the proposals were. And what we saw is that very quickly we jumped up above 30% effective tariff rate. And then that finally started to slow down, and then it kept dropping. The courts got involved. It went below 5%. The courts basically said, no, wait a minute, we're going to put a stay on that. And then it started jumping back up again. And so we went above 20%. It looks like now we're going to be starting to level set closer, somewhere between 15 and 20%. But this roller coaster ride is what has given us a huge amount of anxiety. And so when we talk about the uncertainty in the market, this is what we're talking about. So now, where we truly are, when we look at the effective tariff rate, it's actually sitting just shy of 10%. But that means it moved from 2.5 to almost 10% in a very short period of time. So what we're seeing is we are seeing inflationary pressure coming from those taxes on tariffs, and it's bleeding through. Now, ultimately, the million-dollar question is, what does the market look like as we get going over the next few quarters? Well, with what we have seen and the amount of uncertainty that's happening right now, is what's going on is they are cutting back. And Joseph will talk about the rail equipment market, but I'm going to talk to you for just 1 second on another area that we have seen as a noticeable slowdown in order activity, and that is in heavy trucks. It is following a very similar pattern that the rail car market is doing. They are down 30% year to date, and it has been very, very difficult for that market for heavy trucks. We're seeing the same type of thing in the trailer market, so it's not just one given market saying we're not going to participate. The other thing is as we look out to next year, there's still a lot of uncertainty about China, about Mexico, about Canada, how that is going to play out. We have thoughts on that, but I don't want to belabor that too long. But suffice it to say that if it plays out the way that we are starting to hear that it may play out, this means that we have an even further extended cycle of uncertainty, which means that people sit and do nothing for a whole nother year. That would be a catastrophe. But that seems to be kind of the trajectory that we're going along, and that I think would be problematic. Okay, let's talk a little bit more about trade, right? So we talked about the tariff situation, but if we start looking at what's happening within the trade environment, what's going on with imports and exports? Well, there's a couple different things. So there's on this graph, what we're looking at is the top line up there is total imports. And we said, okay, well, we know that there were some kind of funky things happening there with gold, with pharmaceuticals, some computer stuff. So we said, let's take out some of that strange volatility. Well, when we do that, then that brings us to that second highest line, that reddish second line there. And what we see is it's a very similar pattern, but it's not. It doesn't have the huge up, and it does have the correction though. So what we saw in the first quarter is once the tariffs were announced, everybody went out and they said, "Oh my gosh, I'm going to import a bunch of stuff." Those all started coming in, and then they said, "Nope, I don't need to import." So one of the concerns that we had was that there was going to be a huge amount of excess inventory. That has not materialized. We did see some inventory accumulation, but not to the level that it is critical. So where we're seeing high inventory levels is in manufacturing but we've actually seen wholesale come down, and we actually have seen the retail market coming down relative to sales activity. Those are good things, meaning that we're not in a really awkward situation. If things do start to slow down further, we can weather that a lot better. The other thing, though, is if we look at that very bottom green line, what we have seen is that exports have held up. We saw them kind of bump up just a little bit and they kind of came back down, but it's fairly flat. And so, for some of you that have heard me speak before, one of the things we were concerned about is we were concerned that the value of the dollar would start to appreciate, and that would put a lot of pressure on the export market, and that it would potentially go down. That has not materialized. So I think that that's kind of a win from this particular situation. But it's something that we need to be paying close attention to as we get going out over the forecast horizon. Okay, let's talk about what our outlook is so that we can kind of put you in the right mind frame when we start talking about what is the outlook for equipment. So if we look at GDP, for example, that is the broadest measure that we have out there for understanding what the market is doing. It's not a perfect metric, but it is one of the ones that we like to look at, that the market generally looks at to understand what's going on. And the reality of the situation is that we see a expected additional fall off as we start going into Q4 and into Q1. Traditionally, we would normally have the first Q3 numbers coming out. They are delayed because of the government shutdown. We don't know the timing of when those will get released, so we'll keep an eye on that also. But what we're seeing right now is we're not expecting a traditional recession at the moment. We're just seeing this slowdown that gets us closer to that 1% type of growth and then slowly creeping up towards 2%. I do think that there is more downside risk than there is upside risk, meaning upside opportunity for the market to expand. In general, my concern is as we start thinking about the first half of next year is what does business investment look like, and are they able to continue production and keep the labor markets relatively healthy, because those have been struggling as of late. Let's transition a little bit more. So let's talk about the goods transport sector. So what we like to do is we like to say, okay, here's the broader measure of GDP. Let's take those components of GDP that are goods producing. What does that mean for the transportation market? So when we take those goods markets, we add them all up, we do one additional thing. So when we do GDP, an imported good, or just an import in general, is a negative to GDP. But from a transportation perspective, we're like, well, that has to get moved. So we add that back in so it becomes a positive for the market. And so therefore you don't have that offset. That's why we have that big jump in Q1 and a big fall off in Q2 that is being primarily driven by the import of goods market. What's interesting though is as we look out of the forecast horizon, it is very subdued growth. In fact, we see negative growth for a couple quarters before we start seeing a little bit of growth. To put this in perspective, though, what does this mean? We really need to see the GDP goods transport sector growing somewhere north of 2.5% to 3% for it to generate real freight traffic within the market. And so clearly, as of now, we are barely getting to that level by the end of 2026. So that tells us we're really looking at a fairly flat market, maybe even a down market, as we look out over that horizon. And that is highlighted by when we look at the industrial sector. So if we look at industrial production, we actually have that falling in the fourth quarter and in the first quarter of next year. That is being driven heavily by businesses in general not ordering equipment and not buying, and they're going to continue to hold back. So this is probably the biggest the area of concern for us. We will have to see how this market plays out as we move over the next few months. But what's interesting is this data actually has been delayed. It's usually published on a monthly basis. We did not get the latest month, so we don't even have a good understanding of what truly happened. But we do have a good understanding of what the fundamentals are in the marketplace. And they're not fantastic right now. They are just ho-hum. It is a very flat market, and this is where it creates a lot of uncertainty for a lot of the players within this particular space. Let's move on to talk about transportation specifically. I'm going to cover what's happening within the truck space, then I'll hand it off to Joseph, and he'll hit the intermodal, the carload, then we'll jump right into the equipment markets. So if we look at what's going on with truck traffic, as I mentioned, the industrial sector is a big part of that. So to put this in perspective, about 75 to 80% of all freight that gets moved is due to the industrial sector. It's manufacturing. The rest is more of that retail side. Retail is a much smaller portion than what most people traditionally think about when you hear freight. What we're seeing is that we do expect further downshifting, and so that line is the absolute level of freight that's in the system, seasonally adjusted, and the bar is the year over year. So we still see year over year things coming down or flattening out, but it's very, very flat. So this does show us that the line starts to increase as we move to the second half of the year. But it's not significant. It's still below 2% by the time we get out to the end of 2026. And in general, when we look at the annual numbers, 2025 was just a little bit above 0.5% growth. We're going to see just a little bit below 0.5% growth in 2026. So this market basically has stalled out. We are not seeing growth within this particular space, and that's creating other issues. So if we then say, okay, well, what's the capacity situation look like? Because everybody's trying to understand, are rates going to go up? Does capacity tighten? Does it push more stuff towards the rail system or not? And what we're seeing is that capacity utilization actually is getting a little bit better. And so there has been some tightening within this market. Now, this data is not telling us everything that's happening because the rate environment has been very weak and we have not seen a turn. What we have seen is that we've seen more drivers sitting off to the side, so that's putting the utilization higher. So what this is measuring is how much freight is in the system, and then how many trucks are seated with the driver saying, pick me, I can move freight. So this is artificially looking a little bit higher. If freight starts to pick back up, then those drivers come back in, they sit into a truck, and then things start to churn. But we don't expect it to go up towards that 100% level, and that's usually when we get significant pressure. But it is moving in the right general direction. But my gut tells me that we're probably expecting it to get a little bit a little bit higher than it will on this particular forecast. It'll probably stall out into that mid to lower 90s is kind of my general expectation. So with that, let me pass this off to Joseph, and we'll kind of hit on the intermodal and then into the carload space.
Yeah, thanks, Eric. So kind of just highlighting some of what Eric talked through, a lot of the softness that I'm sure many of y'all are seeing in the freight environment and in the equipment environment. It's not limited just to the rail side of the equation. So it's been a pretty flat industrial economy. It's been a pretty weak truck side of the equipment market. Truck freight also not doing that great. And so a lot of the issues that you're seeing here on the rail side, as we'll get into, a lot of the industry is facing a lot of the same problems. But starting things off, looking over what's been happening so far this year with intermodal. So talking through the high level, just on a weekly basis, what has intermodal traffic looked like? So far into the year, intermodal's been pretty strong, just looking from a pure year-to-date perspective. So year-to-date, we're up 3.3%. And a lot of that has to do with a lot of the pull forward effect that we had at the beginning of the year. And then more recently, looking more in Q3, it was a lot of easy year-over-year comparisons, especially among the East Coast carriers who at that time were dealing with a port strike, and a lot of their volumes really came crashing down. Uh, as expected, though a lot later than we were actually anticipating, we have started to see things go negative for intermodal, to where actually the most recent week of data showed year-over-year growth for the first time in 5 weeks. But that's also really misleading. So there was all the attention's kind of been on the East and Gulf Coast port strike, side of things, but understanding what's going on with intermodal. But there was actually this time last year a port strike in Canada, across Canadian ports too, that impacted both the ports of Vancouver and Prince Rupert. And so we had a crazy like 60% year-over-year growth this week for Canadian intermodal. And that's actually why why it shows up positive this week. It's actually, if you take that out, you just look at U.S. carriers, things are getting increasingly worse, really across carriers. So for the most recent week, we actually had all four of the U.S. Class 1s report negative year-over-year growth, with really everybody except CSX being severely negative. So it's softening environment. I would imagine this is going to continue. This was expected in a lot of ways. And so overall, as we finish out the year, we're expecting that things are going to drop down from the 3.3% growth that we're at year to date down to 2.0% as we finish out 2025, with most of that growth attributable to what's been going on with the international equipment as opposed to the domestic side. Again, talking through everything that's been going on with international imports, pull forwards, rerouting, all of that stuff. Similar to what we see with trucking, where we're expecting to see a 0.4% increase in loadings, we're expecting a pretty similarly flat level of intermodal loadings, intermodal originations as we get into 2026, growing by just 0.7%. So it's very much the same type of environment. That comes from weaker expectations on imports, which were front loaded this year, and it shows a little bit more growth attributable to the domestic intermodal equipment, and a little bit weaker on the international side, with lots of different reasons that we can get into. But the big picture is that it's going to be a soft overall intermodal environment. Similar to what we see in trucking, and what we're going to talk through next in the carload side. So talking through carloads, unlike intermodal that had a really strong first half of the year, it hasn't been near as strong for carloads, but it hasn't been horrible either. So year to date, overall North American carloads are up 0.5%, with a lot of different forces at work. So one of them that has been kind of pushing volumes up has been coal traffic, which is really just a matter of a really weak 2024, making year-over-year comparisons easy. Grain is another one that has been performing well. But then on the counter side, a lot of the industrial commodities, specifically referring to wood products and then metals, are two that have suffered really through 2024, and they've continued to suffer into 2025, and they're suffering from a lot of the same environment that the industrial economy is going through, that a lot of other industrials are having to struggle with. So high interest rates, still higher than hoped for inflation, general uncertainty, tariffs affecting things like Canadian softwood or Canadian steel. Those are all factors that are really playing into why those commodities specifically have been low. And it seems like they're going to stay low. So as we look into what overall expectations are, I'll actually skip slides around a little bit. Overall expectations for the year is that we're going to be right in line with where we are year to date, which is up 0.5%. And then a lot of the commodities that are struggling right now, we're actually thinking they're going to sort of stay in the trough. That it's not going to be a robust recovery in 26 at least, when there's still a lot of uncertainty about what's going on, where there's still a lot of tariffs that are going to be put in place in industries that really impact rail. And so as we look into 2026, we're actually expecting slight negative year-over-year growth of 0.1%. That shows a lot of those industrial economies staying in the trough. That's a return to year-over-year declines for coal, and then the rest of the commodities kind of just staying more stable year-over-year. Next, I want to talk through economically sensitive freight, and we'll go through this somewhat quickly before going into some of the equipment stuff. But this is really just looking at overall carloads and then stripping out some of the commodities that are less sensitive to economic activity. So economically sensitive freight, if you're not aware, it strips out coal, grain, and crude oil. And then from there, we kind of get a feel of those other commodities that are a little bit more, they move up and down with the ups and downs of the overall industrial economy. Has not been a markedly better year when you look at just economically sensitive freight. And then when we look at what our total expectations are for the year, because we don't get that little recovery from in coal, that's the biggest thing going on here. You see a bit of a year-over-year decline. You also strip out a lot of the strength that we've seen in grains, and you get about minus 1% expectations for 2025. But then as we get into 2026, it's a little bit better of a picture, but it's not anything that's going to significantly change what the underlying freight environment looks like. So yeah, we have 1.2% growth, but that follows a year of 1% declines, which followed a year of 1.4% declines. And so while we do see a little bit more activity than what we see looking at the big picture, still not going to be that robust of a freight environment from a carload perspective. So that's the big picture on what's going on with rail freight. And then the next thing that we're going to talk through is we're going to start focusing a little bit more on equipment. We're going to start at the big picture, what's going on with utilization, orders, deliveries, backlogs, and then we're going to dive into car type by car type indicators. And then we'll open things up to any sort of Q&A. So any questions that y'all might have on anything economy, freight, or equipment related, be sure to submit that into the Q&A so that we can be sure to open up that conversation as we get to the end. So the first thing we want to talk through, Eric showed a similar metric for the trucking side, but just understanding what's going on with utilization before getting into some equipment markets. And before doing that, I just want to explain what utilization is, because that word means a lot of different things to a lot of different people, depending on where you live in the economic or in the rail car environment. So this is really just a barometer of the forces of freight and equipment populations. It really just looks at all the equipment that is out there in North America, and then all the freight that either has been moving or that we anticipate to move. And it's a calculation of how many rail cars, what percent of rail cars are actually needed to move what we anticipate is going to be moving freight-wise through North America. And so kind of finishing out 2024, getting into 2025 on pretty high levels of scrappage. We were in a place, we were sort of at the long-term average for this metric, right at about 75%. One thing that we can talk through it now. One thing that's been going on is we've seen pretty consistent levels of overall deliveries and a pretty significant slowdown in retirements out of the North American fleet. So more cars are being added, less cars are being scrapped. And this comes amid a pretty soft freight environment. And so the result of this is that we've seen a ticking down of these utilization rates. And then as we get into 2026, we're going to be kind of in a little bit in a bit of a slack environment where we hover around 72% for most of the year. I was asked recently, what would this look like if you were to remove some of the distressed assets like your small cube covered hoppers or a lot of your coal fleet? How would this picture change? And you might see it, move up a little bit. But when you think about just the overall market dynamics, you have a low freight environment and you have decreasing levels of deliveries. At least that's kind of how we're seeing things. And you're seeing lower than expected levels of retirement. And so even taking out some of the distressed assets, you would still have this pretty flat utilization expectation where there's some excess capacity that's out there in the environment. And so that just to kind of set the stage as we get into specific indicators on just some of the supply and demand forces that are at work with the railcar environment. So this is where we're going to start getting into orders, deliveries, and backlogs, talking about what's going on at a high level before looking at some specific car types. So we're in this, we've been in this place. So a lot of the uncertainty, a lot of that is rippling through to the equipment markets. It's certainly hurting the industry, but a lot of what the industry is struggling with right now isn't really new. And so we've been at this place for, I think, 9 consecutive quarters now, where orders have been coming in below actual delivery levels. So we haven't been seeing enough orders coming in, but we've seen pretty stable levels of build rates. And the result of that is that we've had overall industry backlog trending down consistently since hitting a relative peak back in 2023. Now that is concerning in any environment, but it becomes increasingly concerning when you're in an environment like this, where you see a pretty significant slowdown in order activities, even coming from a place where things were already pretty soft. And so for the most recent quarter, just talking through some of those high level indicators, total order levels were 3,071 for the most recent quarter. That is the lowest since the second quarter of 2022, when basically the whole world was shutting down because of COVID. And so that's kind of the scale of what we're working with right now. Deliveries were trending down, but they were actually a little bit more stable than we were actually anticipating we would see in Q3. And the result of that is that now we have an industry backlog that is the lowest since 2010, now standing at just 25,000, specifically 25,687 rail cars. That puts the backlog to delivery ratio, which is a metric that we like to follow very quickly, kind of like utilization. It serves as a little bit of a barometer for some of the market pressures that are going on. That brings that number down to 3.5. Now that's to say that at current run rates, we have 3.5 quarters of deliveries, assuming no more orders before we completely deplete the backlog. I typically like to see that number more around 5. That shows that there's not too much overcapacity or undercapacity in the market. And that number has been trending down pretty consistently. So last quarter it was at 3.8, and the quarter before it was at 4.0. So that's another thing where, again, I don't think this is really new for anybody that's really spending a lot of time studying these equipment markets. But it is just one thing that it's been alarming for the past couple of quarters, and it's just gotten increasingly sort of nerve-wracking, at least for me, somebody that kind of lives in this data, in more recent quarters. I also want to talk through, before getting into looking into each individual car type, just what the backlog looks like and how it's been evolving over the past several years. So back in 2021, the last time we had a bit of a build out of new order activity, more robust levels of deliveries, we had a much more diversified backlog of covered hoppers and tank cars, GONs, open top hoppers, box cars, flat cars, you name it. There was a lot more diversity in the backlog, which meant that if one market went up, the whole rail environment doesn't shift as a result of it. But we've been just kind of continuing to move in this space of an increasingly less diversified backlog to where over 80% of the backlog now is over 80% covered hoppers or tank cars, which means there's lots of things that are involved, but that typically mostly means that the new car environment is currently centered around agriculture and chemicals, which is just not a fun place to be, to have this less diversified portfolio where the health of the rail car environment is really going to be moving up and down at the whims of the health of those two overall industries. So that's just something I highlight this pretty much any presentation I give. Just really important to keep a tab on not only how big is the backlog, but what actually makes up the industry backlog. So now we're gonna that's the big picture. So we went through the economy, we went through freight, we went through the big picture with new car activity, and now we're just gonna go through and just kind of riff about what's going on, what are some things to consider with each of the different major commodity types. Just going in alphabetical order all the way through. So right now, box cars, this was one that we saw a substantial build out of activity back in 2022 and 2023, but that's dried up significantly to where the most recent quarter we actually didn't have any new orders come in. Though we did see still, a pretty solid level of deliveries, and that has sort of wreaked havoc on the backlog for that overall fleet. And then looking at what car types these actually are for the box cars, I think most of us would know what that actually is. It continues to be the 60 foots that are really driving most of that activity. And so for the past 3 quarters now, the vast majority of box car deliveries have been those over 60-foot box cars, though we did see a bit of new mechanical and insulated deliveries come in. And I believe we also had some orders too. And by the way, if anybody has any questions on what the specific order delivery backlog, we can talk through that as well as we get through. Then talking through covered hoppers. So covered hoppers, again, this is the biggest portion of the overall backlog right now. So it's really important that we understand what's going on with covered hoppers, and not only at the high level, but the interesting dynamics that's happening with each of the three major covered hopper types. So like what we saw with a lot of different car types, had a big slowdown in orders. And that was especially pronounced for the covered hopper space, to where we actually had negative orders for your medium cube covered hoppers, which is to say we had canceled orders. But that's one of the ones where we were anticipating that the replacement of those medium cubes, used a lot primarily for agriculture service, would be a little bit of a saving grace for the railcar environment, with the idea that these are old, highly utilized cars that are going to be scrapped out. And so those are going to provide a little bit of wind for the industry kind of through this difficult season. And while there is still a good amount of backlogs for those medium cube covered hoppers, order activity was negative for this quarter. And then it was also a bit of a slowdown for the over 5,500 cubic foot covered hoppers used for most notably plastic pellets, but then also a lot of agriculture products are also moving in that category. And then deliveries have been trending down, but we're mostly stable quarter over quarter, which was, I don't know if it's good to say because it kind of comes at the expense of 2026, but it did help the overall Q3 deliveries to not fall so dramatically this quarter. So talking about what specific covered hoppers were being delivered. So in the end of 2024, things were pretty evenly split between the two bigger cubic foot capacity cars. Last quarter, it was much more the over 5,500 cubic foot, and then things have balanced out a little bit more from a delivery perspective in Q3, though again, it's a much different story when you're looking at what actual underlying orders look like. Open top hoppers, and then as we'll get into gondolas next, these are very interesting cars that have actually been, these are the only two cars that we've actually seen orders outpace deliveries, meaning that the industry backlog has actually increased. So every other car, orders are coming in below deliveries, and we're seeing a decreasing backlog. Open top hoppers and the gondola fleets are the exception to this rule. So that's encouraging to say, encouraging to see. Compared to covered hoppers and tank cars, these are still very small portions of the of recent new car activity from an order perspective, deliveries perspective, and backlog perspective. But any hope that we can get is something we're going to cling on to. And we have seen some more activity in, or at least some recent activity. When you look, a few years further back, maybe it's not so optimistic. But we've seen some life in these different car types, which is always nice to see. Not surprisingly, it's been all of the steel cars that have been driving this activity, as it has been for the past decade or so, with the aluminum side used for coal, and really no recent coal car deliveries, nor do we expect any over the next several years, if ever. And then gondolas, like I had mentioned, one of the few fleets where we actually saw recent orders coming in above delivery levels. So a bit more life in here. And when we look at specific commodity groups that are actually making that up, it's primarily going to be your GB steel. So those are going to be a combination of mill gondolas and the coil cars used to serve the steel industry. But then we also had some GT steels come into the mix, which have a more varied use, to where it's beyond what's going on in steel specifically, though they're still tied mostly to industrial sectors, and then some wood sectors like wood chips would also go into the GT gons, but still primarily going to be your GP steels that are moving this, and it's primarily going to be a lot of age-based stuff. So, like I had mentioned, metals has not been doing that great so far in the year. A lot of that has to do with tariffs levied against our Canadian and Mexican partners, which is unique to Trump's second administration. The last time steel tariffs went in place, it was more geared towards overseas partners, where this time it's kind of everybody's being tariffed. And a lot of the weakness in metals, just kind of going back to freight for a second, is tied to what's going on in metallic ores. Things are actually holding up pretty well for the metal scrap and for the metal products. But in any case, it's a lot of the age-based retirement, at least for the car type. So a lot of these cars, if you've ever seen them, if you've ever been stuck at a railroad track and you see the mill gons go across, these cars are beaten up. They age out early just because of how rough people handle them, but still age-based. Just that age of retirement's a lot sooner. Next is non-intermodal flats. This is one that had kind of a soaring 2022, 2023 into 2024. A lot of new order activity and a lot of delivery activity. But recently, as you'll see with that orange line, the orders have dried up. And as a result, we've seen the deliveries, and then not pictured here, but then also the backlogs have both come plummeting, to where I believe we now have the backlog to delivery ratio for these non-intermodal flats is now standing at just 1. So unless there are new orders that come in, or we see a just complete stopping of production levels, the remaining backlog is going to be depleted for these non-intermodal flats by next quarter. Though, again, that's not set in stone. We could see new orders. We could see a slowdown in deliveries, but just at current run rates, we have 1/4 of deliveries left. A lot of the buildup and ramp down of these non-intermodal flats have been tied to the auto rack space. That's been the biggest reason for the upward swing. That's also been the biggest reason for the declines. But we also have seen some of the declines for the other non-intermodal flats, like your general service flat cars. We haven't seen any center partitions, but while auto racks have been the biggest contributor, we've also seen a slowdown in some of the other non-intermodal flats that fall into this category. Next, intermodal flats, and then after that, we'll finish off with tanks. Remember to submit any questions that y'all have about anything econ, freight, or equipment related. Intermodal flats, we don't have to spend a whole lot of time with this one. It's been another quarter of zero. So zero orders came in, zero new car deliveries, and we still only have, I think we have something like 100 cars in the overall industry backlog right now. Notoriously difficult to understand this market because of such a small number of buyers. And for those of y'all that subscribe to our Rail Equipment Outlook, this is one of the biggest revisions to our forecast, is just trying to peg down the timing of when these cars are actually going to be demanded. Um, and so no activity in recent quarters is really the only takeaway with this one. And then finishing things off, talking through what's going on with tank cars. So tank cars have been slowing down a bit, kind of like everything else, but been pretty stable, kind of like covered hoppers overall as far as delivery levels go, which has kind of been propping up a lot of the overall deliveries for the industry. And we actually did see compared to what we've seen for the other car types, a respectable level of orders that came in, though still low, still under actual delivery levels. And so that's resulted in another reduction in overall backlog, with the bigger reduction being for the over uh, over the 26,000 gallon general service, general purpose rail cars. That's one of the ones where we've seen more of the steeper decline in overall backlog levels. But when looking at deliveries, it's actually those same over 26,000 gallon tank cars are the ones that have been driving a lot of the new delivery activity. I would imagine a lot of that's coming out of regulatory requirements, which also makes sense, kind of considering what's going on with backlogs, that we're seeing such stable levels of deliveries, but backlogs have been coming down. I encourage any type of pushback, but it seems reasonable to say that that's a lot of the replacement activity from regulations like 251 that's been kind of driving those market dynamics. But still a decent amount of new car activity for the under 26,000 gallon cubic foot capacity. These are ones that are more tied to a lot of your agricultural products and chemical fleets, where the over 26 are more ethanol, crude oil. So some activity, but not as much compared to what we've seen recently. And then we've actually been heating up with pressure cars. So now for the third consecutive quarter, we've seen increasing levels of overall deliveries for pressure cars. Okay, so I think that brought us through about 45 minutes of presentation stuff. And now Eric and I are going to put our cameras back on. And then if there are any sort of questions or comments about anything that we've talked through, happy to talk through those now.
Yeah, thanks again, Eric and Joseph. Really appreciate you walking us through all of that. We do have one question in the chat from Kim. And the question is, how much of the backlog is in 2027 and beyond?
Um, yeah, you'd probably want to talk to a builder about that one, though the builder probably wouldn't want you to know. So when we're thinking about what the future looks like for rail, I mean, I'll say first, I don't know. That's what I'll say kind of before saying anything else. I don't know the answer. But when we think about what our expectations are for new car deliveries over the next, 1, 2, 3 years, the backlog, we put a lot more emphasis for the near term, with, it is going to vary drastically depending on a lot of different factors, but it takes something like 6 months from the order of a rail car to the delivery of a rail car. So most of it's going to be within a year. That gets fuzzy because you'll have like the GATX deal that happened, I think 2 years ago now, where that was like a long-term plan of, over the next several years, these are how many cars we want to buy from y'all. And so it's going to generally, a lot of the backlog's going to be kind of within the next year. But there are exceptions to that rule. And there's really no, using, the data that's kind of out there, there's no way to really say exactly how much is going to be for the next quarter, how much is going to be for the next year, how much is going to be for the next 2 or 3 years.
Yeah, let me throw a little bit more color on that. The um and I may be saying things that everybody already knows, but sometimes it's good to hear it again. When a multi-year order comes in, a lot of times what happens, if they know the specific cars, then yes, then they go into that backlog for the specific car. Sometimes they don't know. They say, well, we generally know what the mix will probably be, and then so those backlogs go into that mix, or maybe they go on all into tank, or just whatever that looks like. And then as they get closer and then they start to then solidify that, then they will then take the cars and put them in the correct bucket. So it's very possible that they were put in tank cars, and then they're like, oh, you know what, some of those are actually going to be covered hoppers, and so they'll do that. And that's also why you see the backlogs will shift periodically without being able to calculate it through, because sometimes you're like, wait a minute, they took this order in, the backlog was here, they delivered, it doesn't make sense. That's usually what's happening, is they're reallocating those elsewhere.
Great.
So one thing forgot to, I stopped sharing too soon. Just wanted to share one quick thing. Um, so if you want to if you all this information, if you want a sample report of our REO, it's out there. Just follow that link. But then also, if you want these slides, we actually have a landing page to where y'all can download this, have all the insights that y'all want. So if you go to, let's see. There we go. So ftrintel.com/RSI, you can actually get a copy of these slides that we talked through today. But one thing,
That is the
yeah,
smallest font I have ever
yeah.
seen.
Next time, that top right corner, I'll have a big fat, sign that says "Go to this link." But Eric, one thing that I wanted to ask you, as you kind of talk through what the kind of the investment environment that we're in right now, that's kind of attributable to a lot of the lack of a lot of different things. So as we get into 2026, I think kind of coming into this year, we were at a place where we didn't know if we said, okay, people are going to be sidelined for the next 6 months as we kind of figure out what's going on, and then once there's more clarity, then we'll see some more investment kind of come in. At least that was the hope.
Yep.
Doesn't seem like things are going to get any clearer in the near term. And so, do you think that we're going to see another year of kind of just malaise of nothing happening, nobody investing any money? Or do you think we're going to see more of like a, hey, I have this pile of cash, I have to do something with it. Even if we don't have perfect clarity, I'm going to make some investments this year.
So it's a mixture of both. And let me explain that for a minute. I think in general, the first scenario is the most likely, that people don't do anything. They just sit there. However, one of the things that we've been looking at is clearly what's the cost of capital, and if the cost of capital keeps coming down, then that can create more incentive for people to do stupid stuff, because they have cash. The risk becomes a little bit less. So that's not overly makes me feel really, really good. So I do worry that people are going to still have a fair amount of cash out there, and that they're trying to figure out what to do with it. And then when you don't have an obvious thing, then you start throwing money towards stuff. And that can be problematic. Do I think that that will happen within the rail space? I don't think so. I think that probably already would have happened up until this point, because we have a lot of people looking for deals, a lot of people with money, and they haven't been going crazy like that. So, but it could happen within the broader economy. It could happen in other sectors. AI is a big one that people are really looking at. You could see stupid amount of money going towards those types of things. So I do think some riskier investment could be happening as a result. But by and large, my thesis right now is kind of just flat, blah. That's the official word, blah.
Yeah.
I know.
USMCA comes up
Yeah, I know
to.
Carrie was going to say something here real quick. So let me
Oh
give her
no, I
that.
was just confirming I was
Yep, go ahead. Oh,
Um, So
Yep.
USMCA is set to come up for renegotiation in 2026. I think the last time we were here, you talked about your expectations being that the whole thing is going to get blown up. Is that still your view, or has that shifted a bit?
Oh no, no, it's actually now affirmed. It is that whole thing is totally getting blown up. The the administration has pretty much telegraphed that for the most part. Um, so what we haven't seen yet is we haven't seen that full blow up moment yet, right? They haven't kind of laid out all the cards on the table to say, here's what this looks like and here's what we're trying to do. I don't know if they will fully ever do that part of it, but I do think that they will come to the table. They will put some stuff in front of Mexico and Canada, and they will say, here's what you have to do to continue to have us involved in the USMCA. And then if that doesn't occur, then they have a 6 month out. So basically, you have the first 6 months of the year where that's kind of playing out. Then if the U.S. says, if the administration says, nope, we don't like it, we're going to do our 6 month out, then that puts you towards the end of 2026, first part of 27. So that basically is a full year of nothing. And that creates a huge amount of uncertainty there. So I fully anticipate that they want to get out of the USMCA deal. I mean, Trump has hated that from the get go. He was the one who negotiated it. Yet, at the time, I was like, every bone in my body I could feel was saying that Trump does not want to do USMCA. He does not want it. But Leitinger at the time said, we need to do this. Don't rock the boat. And he did it. And now I think he's kind of upset at himself for not having blown it up then. So I fully expect he's going to continue to do that. And that just worries the heck out of me because ultimately, what I'm looking for, and I think what most people, business people are looking for, is some type of clarity. And I'm to the point now where I don't care if I like what he's doing. I don't care if I disagree with what he's doing. I'm to the point where I'm just like, tell me what the operating environment is going to look like, right? What are those things? And then I can then make a decision of how I'm going to run my business. Am I going to spend money? Am I going to reallocate some of the stuff? Whatever that looks like. Because right now we're just in a complete holding pattern of unknown. And if I'm feeling that way, I guarantee you others are feeling that way, especially those that are trying to figure out how do I spend millions and $1 billion in capital, where should I be allocating those resources? And I just am, and the more and more I keep seeing what's been happening is it's not in Trump's DNA to in essence telegraph that or be able to say, oh, this is what the operating environment is. I'm not going to touch it again. And I don't think anybody believes that. And that's really what makes it hard as we look out over the next year and a half. Um, and so those are my biggest concerns right now. And it's less about political stuff. It's more about how do we as business owners and business leaders, how do we make these decisions? And that's really the hard part. So, Carrie, did we lose you? It's very possible we lost you.
Yeah,
There
I
you
it just
go.
booted me off and then I came back. So you may have addressed this already. Yeah, I think there was a question about sharing the links in the chat, which you have already done. And it doesn't look like there are any other questions at this time. Any last minute questions? Anyone wants to come off mute, ask those, or drop your question into the chat.
I would like to pose one to Joseph a little bit though, right before we leave. Joseph, what is the likelihood that the market could be better, right, than what we're currently saying? But what is also a scenario that suggests, well, maybe it could get worse? And maybe a worse is that the numbers don't get worse, it just elongates it. But what is your kind of thinking off of those two things?
Um, Starting with what could make it worse, I think typically what you'll see when kind of going into any kind of economic, well, not any kind of economic slowdown, but I think most of them is the consumer weakens and then the industrial follows, and then coming out of it, it's the consumer strengthens, and then the industrial follows. So there's kind of like, 4 to 8 quarter lag between what happens in the consumer environment and what happens in the industrial environment. And so that's one thing to really track is, I mean, we're an industrial sector, but we're an industrial sector that lags the consumer sector. And so that's one thing to watch out for. If we see that inflate, I mean, well, a lot of monetary policy, depending on what's going to happen there, how high rates stay and for how long, what inflationary impact tariffs might have. So one thing to kind of call out, we talked through what tariffs look like right now. We talked through what trade looks like right now, but we're like 2 months behind on actually having data coming out. So the whole economy is kind of driving blind right now, not really knowing is the economy good or is the economy bad
Right.
right now. So one thing that could make things worse is um, whether it's increases in healthcare premiums, whether it's inflation due to tariffs, whether it's whatever it is, but a really stretched consumer is something that I'm pretty worried. I mean, I wouldn't say I'm worried about. I'm not losing sleep over it, but that's just me. But that's just one thing to kind of keep in mind is what's going on with the consumer. Um, what could make things better is peaceful resolutions for a lot of trade disputes, which could happen or it could not happen. It's one of those things you always hear somebody. There will always be some announcement of, oh, a trade deal has been reached, though we haven't had one of those recently. But I've yet to see one, except I think for the UK and maybe Japan, that a trade deal has actually been signed. So it's all we've made an
Right.
agreement, but nothing's actually gone into effect.
Yep.
But I mean, if we were to see that, okay, this negotiation thing worked, playing hardball worked, and now we're able to, get more clarity with trade. Now we're actually able to get, more unilateral trade between partners. That's another thing that could pick things up. And
Let me let me be a little more specific question for you though. Is what's the likelihood that we see deliveries for rail equipment drop to '08, '09 type levels? I'm having a hard time seeing how that would be the case, but is that a possibility?
yeah, so I mean, if we get more orders that look like Q3, it becomes more and more likely. What the struggle is that we've been in this environment of replacement demand plus a little bit of organic growth stacked on
Yep.
top of it for the past several years. And the market dynamics are there for that to continue. So intermodal cars, they average 21 years old, and their average age of retirement is about 21 years old. They're heavily utilized assets that need to be replaced. Same goes with a lot of grain cars. Same goes with a number of different like gondola fleets. And so you would have to see, because the replacement demand is there, to get down to like an '08, '09 type of level. I think it would have to be just an absolute collapse in freight demand that would cause that, because it would have to
I
be
agree.
freight demand drops off so much that there's no need to actually replace the older cars, which we're not forecasting anything like that. While we're not forecasting any kind of significant growth in freight, we're not forecasting any significant collapse in freight, and I think that's what it would take for those Great Recession level drops in
I
deliveries.
I agree, and it's been interesting because one of the things we've noticed is recently the automotive numbers, the automotive freight rail loadings have come down noticeably as of late, and we've seen the similar thing on the lumber side. So it's very possible that that's kind of a blip, right? And then those kind of rebound a little bit, but it's just been really interesting to see the different dynamics that are there. But I'm with you. I think need to see a full, all the markets really retrench a little bit noticeably more for that to be the case. Okay, well, great. I think we've killed a full hour. So, Carrie, it is always so great hanging with you.
Oh, thank you again, Eric, Joseph, for being here and walking us through the information for Q3. We will make sure that we send out an email to everyone who was in attendance today. I know the slides are available on the FTR website. So thank you again. We appreciate it. Thanks for joining everyone, and we hope to see you next quarter.
Thank you.
Thanks, everyone.